My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. What can you say about a stock market that's roaring despite all the craziness, all the lunacy that we're facing? Dow surging 543 points. S&P soaring 1.95%. NASDAQ pole vaulting 2.59%.
That was easy.
We've got the possibility of disputed election. President firing off lawsuits in the states where it's close. We're seeing more than 100,000 new COVID infections per day. Unemployment could be spiking as government-mandated COVID shutdowns loom. Does the market suddenly love uncertainty and out-of-control pandemics? Is that what's happening? Isn't that supposed to be the opposite of what's supposed to occur with stocks? No. We're gonna blow some doors off here today. I'm gonna tell you what's really happening. I think investors in this nutty time are starting to embrace a new way of looking at equities. We're hearing now, for the first time in my career, that stocks have become repositories of real value. And I know that's driving all the old-time professionals nuts. They don't want to hear that. We're hearing that the nature of the asset class is changing, and we need to reconsider what stocks might be worth versus other investments for the long term. In other words, maybe stocks are worth more than we thought. All stocks. If only because it's all relative, isn't it? It's all relative. And maybe everything else that we used to revere is worth less. Today, I listened to Jay Powell, earnest, smart Federal Reserve chairman, one of those monthly conference calls, explain how he'll do whatever it takes to keep the government going. He knows things are troubled, right? But he needs, and I quote, all of government working together, end quote. I wanted to laugh. I mean, like, hey, Jay, come on, man. That's not possible. Nonetheless, Powell will do his part to prop up the corporate bond side. You know, he can work on that side of the table, bonds. The Fed's bond buying is keeping many companies alive in this environment. Let me put it this way. I mean, without Powell, you think the airlines, the cruise lines, you think they'd be trading? They'd be dead in the water. They would have been in their third prepackaged bankruptcy, for heaven's sake. Have you seen their balance sheets? They look like they should be on death's door. But Powell's bond buying has taken away the balance sheet risk. If you're a troubled public company with public debt, this man is your guardian angel. Unfortunately, there's only so much the Fed can do. Their toolbox doesn't work for small and medium-sized businesses that I'm always talking about here because that's one of my causes, okay? And that's where Congress has to come in to help. The hospitality industry employs 14 million people who are hanging on by their fingernails right now. And as it gets colder and COVID keeps running rampant, more and more of them will lose their jobs because they can't have a lot of people inside the restaurants and bars without having the viral load go too high and people getting sick. Jay Powell can't extend his safety net to them, which is why our elected leaders need to step up in with another stimulus package, even as so much of the big part of the economy, as represented by the stock market, is doing so well. It's not the real economy, but it's the stock economy. Still, the Fed's far from powerless. If Powell wants to save the economy, he needs to keep interest rates extraordinarily low for a long, long time, right? That's his gig. But what does that mean? I mean, we always act as like, wow, I guess maybe bonds aren't so good anymore right now. Maybe they shouldn't buy them right now. Wrong. It means the bond side of the equation, long considered a fabulous repository, remember that word, repository of wealth, has become a lot more capricious, a lot more mercurial, a lot more uncertain. Sure, the Fed may be able to provide emergency liquidity, but you barely make any money at all owning bonds. The risk-reward seems okay for the moment, maybe. Although when Powell's done stabilizing things, I can't imagine a reason in the world why you'd want to be in any bond. So bonds have lost their luster as a repository of wealth, and it might be permanent. But what about the repository of wealth that stocks represent? I remember the day I first walked into Goldman Sachs. It was 38 years ago. And I got schooled by someone who's now an old friend about the value of stocks versus bonds. Oh, I love stock market. That's why I went to Goldman. I mean, I love stocks. I had all these tremendous ideas. I wanted to tell everybody about them. He let me go on and on until I named enough stocks to create a Jim Cramer index. And that was before there were ETFs. Then he looked at me and he said, never mention those stocks or any other stock ever again, ever. What the heck are you talking about? I love stocks. I'm a gold buy. I love stocks. He told me, he let me let you in a little secret. Stocks, they go down. Bonds, they don't go down. I said, but I could never make that promise. I wanted to make people money. This is Goldman Sachs. He basically said, no, I know what I was talking about, especially since the clients I'd be talking to were already rich. You only need to get rich once. All these people simply wanted to do was preserve their wealth. They didn't care about generating huge gains that I couldn't deliver on anyway. Okay? Stocks go down. Bonds don't. But what if they actually wanted to own stocks, I asked? And he said he told me that I had to discourage them at all costs to ever buy a stock, because if a single stock went down and they lost money, we'd lose the whole account. So I begged him. I said, well, what if maybe let them buy a couple stocks? He said, make sure it's their own ideas. You keep your ideas to yourself. As it happens, I ended up doing both. I helped my clients stay rich, and I kept my ideas to myself. Specifically, I invested my own money. I made a fortune enough to own hedge fund, and then retired and do the darn show. That's my life's arc right now. It's all right. Could be worse. Anyway, it worked out well, I think. But what does this story have to do with today's miraculous rally or the endless rally? Frankly, everything. Everything. And no one else is talking about it. You see, if you put me in charge right now of that Howard division at Goldman Sachs, I'd say, when rich people come to see you, you have to tell them that they need to take less risk and preserve their wealth. That means they need to own a lot fewer bonds and a lot more stocks. Yet this year, we're witnessing the passing of the torch. Bonds were the safest assets back in '82, back when Treasurys yielded double digits. Now they're risky assets, maybe riskier than anyone thinks. Sure, you only need to get rich once, but if you want to stay rich, the old shibboleths won't work anymore. The truth is, for many companies that we follow, the equity side is a much better, safer side, a much better repository of wealth for you, the individual, than the credit side. Not all of them, but a surprising number. Think about what's 25% of this market? It's the Microsofts, the Apples, the Facebooks, the Apples, right? They are sitting on more cash than most countries. Microsoft's got 138 billion. Google's got 133 billion. Apple's got 192 billion. Even the smaller Facebook has 55 billion. Collectively, they're richer than everybody. Think about it. They survived the Great Recession, and what happened? They came out stronger. The countries didn't. In the Great Pandemic, they're not just thriving. But they are actually putting up unbelievable numbers. The countries, they're hoping to survive. These guys are thrive. They haven't been touched by our crazy presidential politics at all. It hasn't laid a glove on them. In fact, these big tech CEOs are so statesmanlike, they make most of our politicians look like they're from Hail Fredonia. To mix metaphors, Facebook, Apple, Amazon, Microsoft, FAM are the Fort Knoxes of our era. They'd be prime targets for Goldfinger, although he'd fail, of course, because Sean Connery, whom we miss very greatly, Sean Connery's Bond would stop him. No, I take that back. Forget Bond, James Bond. From now on, it's stock, James Stock, because these stocks are the new repositories of wealth. That said, it is a brand new thesis, I admit that, even newer than the love affair with Bitcoin. You might dismiss it out of hand, but in a world where some mysterious figure creates an invisible currency and nobody knows where he lives, it's loved by the rich, I think you'd have to be nuts to consider equity as a second class to that, let alone bonds. Yeah, gold's got some luster, the gold miners are okay, but, you know, and I like being able to feel bullion. That fits better than staring at a ledger. The real lesson, though, of this era, of this week, of this month, of this year, is that stocks are the ones that don't need government help here. Bonds do, the bottom line. That means if you're a young, wet behind-the-ears broker at Goldman Sachs, I would tell you to forget all those bond ideas. Just tell your clients to buy the stocks of terrific companies with fantastic nation-state-sized balance sheets. You'll do much better with a heck of a lot less long-term risk and more dividends. The best way to look at it? You only need to get rich once, but you better own some stocks if you're going to stay rich.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.